What's good, everyone? Welcome back to the Crypto Command cryptocurrency course. My name is Gabe, and in this video, we'll be going over technical analysis. I'll be on TradingView showing you guys how to read candlestick charts, looking at the various indicators and how to use them, and then finally looking at the various trading patterns that you'll use in your trading. So let's go ahead and get straight into it. Alright, what's good, everybody? I've hopped onto TradingView right now, tradingview.com. You can see the URL up here. So before we get into candlestick charts, I just want to explain how we even got here in the first place. So when you hop on TradingView, you can type in the trading pair that you want to do. I have it set to crypto, and I'm trading Bitcoin USD. So that's just BTC USD, and alternatively, you can literally just type in Bitcoin. It's going to show you all these options. There's Tetherist, which is a stable coin. There's Bitcoin, THB, whatever that is. And it shows you the exchange that it's gathering this information from. So here's the Bitcoin dollar. Right now I'm just on Bitcoin USD. I don't even really know what exchange it is, but the prices are pretty accurate regardless. So yeah, that's how I got here. Right here is your time frames that you can look at. So you can select the time frame that you want to trade at, and you can see how it's going to change the chart. So let's say you're trading on the hourly. We can go ahead and click on the hourly, and it's going to have it all on the hour, to where each candle here will represent 1 hour. And then you can make it bigger by scrolling up here. You can extend your time frame by scrolling out or by scrolling in to condense it. And that's pretty much how that works. I'm going to go ahead and change it back to the daily, though, because I like looking at the daily. And I'm going to go ahead and make this a little bit smaller and zoom out quite a bit. So that's just kind of how you can navigate around this. And I'm just on this crosshair tool here, and it lets me drag and move around, and it is quite nice. Over here we have the candles. There's different stuff you can use. I recommend you just stick with candles and turn on some dark theme. It took me a while to figure this out, but pretty much right click on here, go to color theme, turn it on dark. That just makes you look 10 times cooler while you're trading crypto, and also maybe it's better for your eyes, but I kind of doubt it. So yeah, the last thing you need to know up here are the indicators. Here you can pretty much type in any indicator that you think you might use. People will pretty much just program this into TradingView. I don't even know if they get paid for it. But regardless, if you want to look at exponential moving average, you can type in EMA and find the EMAs that you like. You can type in MACD, and there's so many different types here. It's quite incredible. You can even do RSI. They got everything. All right. So that's pretty much how you search all these up, and we'll go over that in just a bit. So when it comes to reading these candles, I'm going to zoom in here just so it's easier for you guys to see and understand. So let's look at this candle right here. This is a nice looking candle. So to understand this, there's basically two parts to the candle. There's the body, and then there's the wick, which you can see is that thinner part down here. And the body's this thicker part right here. Now this candle is green, which means the price went up because people bought. And there's a red candle right here, which means people sold. So the price went down. So to understand how these candles work, you're going to start looking at, let's take out this tool here so I can draw a little bit. All right, so here's our candle. So first thing to note is the open price. So each of these candles here will represent a day, because we're on the daily time frame. So this is a day, this is the next day, this is the next day. All right, that's how it works. Now, this is going to show you all the price movements during that time frame. So the first thing to note is the open, which is right here. All right, that's where the body meets the wick. That's where the price opened, which means when this price closed for the day, the next day it opened up here at 12 a.m. And the price started doing some movements. Okay, so that's where it opened. To know where the price moved, you can look at right up here. This is where the price closed. So at the end of the day, the price closed up here, and it started the next candle for the next day. Down here we have our wick. The wick shows you how low the price went during the day. So if you want to know the low of the price, you would look at down here. This is how low the price went during that time frame. So when it opened, the price likely dipped, people rebought, went up here, and there's not much of a wick up here, but there's a tiny bit of a wick, and you can see that it went, a little bit higher than the close, and then it settled on the close, because the top of the wick shows you the high of the day. So it's pretty straightforward like that. And then for sell, it's just kind of opposite. So at the top here, this is where the open is, because the price started up here and it fell down here, and that's where it closed. It closed right here. All right, and it opened right here. So the price fell because it's red, and the price went as low as right here, but it rebounded, closed here, started the next candle. So the price, it opened up right here at this yellow line that I drew. It went up to this high right here, and it then fell down all the way to right here, and then it went up to the close, and it started the next day. And you can see that it went up all the way up here, it fell all the way down here, and then at 12 a.m. it closed right here and started the next candle. So that's pretty much how these candlestick charts work. I'll throw up an image that you guys can look at to kind of just break it down even more. So yeah, understand how these candlestick charts work, because that's how you're going to have to do your technical analysis. And you know, it just shows you all the information that you're going to need. All right, so now that you understand how to read candlestick charts, we're going to look at how to use the tools available to us so that we can perform high-tier technical analysis. So I know there looks like a lot here. You probably don't know what they do. Probably looks confusing, but the good news is there's only really a few that you really need to understand. And the truth is, they're not that hard to learn. So first things first, we have our cross up here, and you can change this to whatever you like to use. I personally just like the cross, but they have an eraser if you want to erase stuff for whatever reason. But we don't make mistakes here, so we never use that. But anyways, I'm kidding. I like the cross here. Kind of reminds me of Minecraft. Looks cool. I don't know. This is what I use, and you can use it to basically drag around the chart. It's quite nice. I use probably this tool the most. But this isn't really going to help you with technical analysis too much. You're going to need to draw some trend lines. Now, I'm going to use some terms you probably don't understand yet, but we'll get into it. Don't you worry. So first things first is our trend line. You can go ahead and click on this trend line, and you can use it to draw trend lines. So you click where you want to do it, and you don't have to hold it down. You kind of just drag your mouse where you want to put it. And let's say, you know, it kind of bounced right here. You can just use this to draw out where your support and resistance lines are. Don't worry about what that means. That's kind of what I use it for. And you can kind of see we have our resistance line where all the prices kind of have bounced off of. So that's kind of cool. And then you can also, there's another tool down here that I like to use. All these different types of tools here, they pretty much all do the same thing, but I really like this horizontal line as well. So we can see like a lot of strong resistance. If you just want to draw support and resistance levels, you can just go ahead and click right here, and it's just going to draw a horizontal line all the way across forever on your chart, and that's going to map out support and resistance. And you can change the colors here. I like to keep my support green and my resistance red. It just helps me visualize what I'm looking at, but it's really up to you how you want to do it. Next tool that we have here is our Fibonacci tools, and they're pretty simple to use, but we will talk about that later. Don't worry about it right now. Next tool is this brush. You can kind of draw your price predictions maybe. Maybe you think this is the top or something. It's going to come down here, bounce off or something, and come down here. I don't know. You can just use this to kind of draw what's going on, or maybe you want to write something up here. I don't know. You can use this as a brush. It pretty much just draws whatever you want it to draw. It's simple to use, and you can change the color, change the width. So yeah. There's also this typing tool. You can just click and type whatever you want. It shows up here. You can change the color, the size of the font, you know, put some borders, make it look nice. Here, if you're ever publishing your charts and stuff, some people like to use text to kind of explain what's going on. But yeah, that's just a tool available for you to use as well. There's also some arrows and stuff. You don't really need to worry about anything else here. This is pretty much all I ever use when doing technical analysis, and that's probably all you'll ever use. The rest here is just kind of, I don't know, it's just there in case you want to use it. So yeah, that's how all the tools really work. Let's get into what technical analysis is all about. So with technical analysis, what you're really doing is you're drawing out the emotions of traders. This is not some crazy price prediction tool. You cannot predict prices, but what you can predict are the emotions of other traders, which influence the price. So in turn, you can kind of get a general idea of where the price is going based on previous trends that have occurred in the past. And the whole basis of technical analysis is to see how supply and demand will affect the price of the asset. And you're going to do that by drawing your stuff. You're going to draw out the price changes that reflect the emotions of other traders. So the two very simple terms that you're going to need to know are support and resistance. So I'm going to go ahead and use this horizontal line here to draw my historic support and resistance lines. So when we have resistance, like up here, this means that people weren't really comfortable with buying in this area, and people were most likely selling, which drove the price down. So when you have a resistance line, that's typically where the price is going to return from. It's not going to pass. It's going to be harder for the price to pass at. So we can go ahead and click here and turn this red to show that we have resistance up here, meaning if the price ever returns up here, it might fall back down. It's likely to fall back down. And then we can also use it to draw our support. And the support line is where people are comfortable buying at, which is going to drive the price back up. So this is the line where the price typically does not fall below, or at least it's harder to fall below. It'll typically pause before falling below, however you want to put it. So we can use our horizontal tool to kind of draw our support line. So now we can see our support and resistance, and you can do this a numerous of times. You can draw all your resistance, all your support levels to see where the price is going to be going. So you can draw these support and resistance lines wherever you want, really. And you can even use these trend lines to show moving support and resistance. So we can say that, yeah, we saw some kind of pattern here where the resistance was falling. So you could draw that out like so. And you can see like how the price has hit this resistance line multiple times, which typically makes it, pretty strong resistance. It forms that pattern, and then you can kind of see there's a little bit of a breakthrough here. So those are just things that you can use the support and resistance for. And you can also do the same thing with support as well. If you see support moving upwards, you can like zoom in here, and you can like draw some moving support and resistance so that we know that there's seeming to be some resistance along this line right up here, so we can kind of draw that out, and we'll extend this just to make it look nicer. And then we will also draw some support right around here where we can see that the price is moving towards. And this right here is what's going to give us a pattern. And I'll show you all the patterns that I like to look for, but right now we're just looking at support and resistance. So that's just kind of how you can use those tools. Once you're done with support and resistance, you're probably going to want to look at some technical indicators or even your Fibonacci. So let's go over the Fibonacci real quick. So what the Fibonacci is it's basically a sequence of numbers in which the next number in the sequence is the sum of the previous two. So it's going to be like 0, 1, 1, 2, 3, 5. You kind of get the gist, right? Why this works? Really because of math. This is just some crazy math that just traders think works, and because traders think it works, people will be trading to the Fibonacci, and if people trade to the Fibonacci, then the price will reflect it. So to use the Fibonacci tool, you're going to have to click on this arrow here, and you'll have to select the Fibonacci retracement tool, which I like to use personally because, at least in my opinion, it's been quite accurate. And to use the Fibonacci tool, what you're going to do is you're going to click at the bottom of the movement and draw it to the peak of the movement. So here's our movement, and you can do this on any time frame, but I'm looking long term, so I drew it from the bottom of the movement all the way to the peak. And what this is going to do is give us our Fibonacci levels. And these levels are typically regarded as support or resistance, depending on where the price currently is. So you can see how this is kind of lined up. We have the resistance right here. We can kind of see that there has been some support around this line in the past. Definitely some support around here. It hit resistance at this level right here. So you can kind of see how this lines up, and really it's just because of math. There's really no great way to explain it to you. You just have to trust the math on this one. So yeah, that's how this works. And you can see all the levels here that we have. We have our 23.6%, our 38.2%, 50%, 61.8%, 78.6%, and the 100%. So yeah, these are the levels that I like to use. I think you can customize all these levels if you want. I don't recommend you do. I don't recommend you change them at all. Just keep the default levels that they have for you, because those are the ones that typically work the best, and they pretty much get the job done. So these levels here, you can use them as support and resistance. And it's also worth noting that when you draw out this line, this 0.5 level right here, this 50% level, is typically regarded as either really strong support or really strong resistance. So what I mean by that is if the price is above right here and it dips below this 0.5 level, then that's typically a buy indicator for a lot of traders, because that means that it's kind of like discounted in other terms. It's a good place to buy in at, and you can kind of see how this is held true. Every time it's dipped below this 0.5 level, people have bought in, forcing the price up. And especially right here, after we've already drawn the peak to the movement, you can see that people have bought in here, which drove the price up. So 0.5 level is always a great place to buy because it is just really strong support typically. Now, if you want to take Fibonacci to the next level, you can draw some trend-based Fibonacci, which I love to use a lot because I found this to be quite accurate in my opinion. So what I do is I go up here, I click on trend-based Fib extension. Now, the way this works is it's another Fibonacci, but it's going to give you more levels to look at. So you're going to click at the bottom of the movement. You're going to draw it to the top of the movement, and then you're going to draw it towards the retracement. Now, the reason it's called a Fibonacci retracement, and I forgot to mention this a little earlier, is that because typically the prices will retrace at each level. So let's say we have a move from the 0.5 all the way to the 0.618. Typically, it could retrace back down to this 0.5 level. That's typically kind of how it works. The price will move in between the levels, and you can kind of see it right here. You can see how let me zoom in so it's bigger for you guys. You can kind of see how the price has moved in between this level, and that's kind of what we call a retracement when it hits a resistance level and then retraces downwards. So that's kind of what you're looking at, and that's why it's called a Fibonacci retracement. So this tool is great. So I showed you guys how to draw it, and now we have more levels to look at. And this kind of gives you ideas of where the price can move in the future. So if you're really bullish on this and you want to know, where can I take profits? Well, where are other traders looking to take profits? They're probably using the same tool here, and they're probably looking to take profits at this 1.618 level. Why? Because that's just where people feel like is a good place to take profits at. So you'll probably see people taking profits somewhere in this area right here. So as you move upwards, you'll know to start taking profits somewhere in here. As long as you're bullish on this and all your patterns and other stuff indicate towards a move up here, this typically works out pretty good. You can even adjust this. Let's say people drew it somewhere. Let's say people drew it like somewhere right here. They drew it at the peak of the movement, retraced downwards. You can see that it's hit this 1.618 level, and it's kind of actually retraced a little bit because people took profits. You can kind of see how it's kind of blasted through it, and that's to be expected. You know, it doesn't always have to stop at this 0.168 level, or this point, yeah, this 0.618 level. It can go forwards, and people continue to take profits. It just kind of gives you an idea of what to look for long term. It doesn't necessarily give you the perfect price prediction, but it shows you where the price could be headed, and it'll show you the levels at which people will most likely start taking profits at. So it's super helpful tool. I like to use it, but it's really up to you if you want to use it. So yeah, let's go over some of these indicators that I like to use, and then we'll look at some trading patterns that I really like. So down here we have our volume. This is typically on here by default, but you can get rid of it if you want. I recommend you keep it there because it's a very handy tool to kind of understand the strength behind a movement. So what each volume is doing is it's also kind of in candle format, except there's no wick, it's just a body. And it's going to show you the total amount of trades that occurred during that time frame. Now, what time frame are we talking about? Well, we're on the daily, so it's showing you how many trades occurred during the daily. And if it's green, that means that the price moved upwards. If it's red, that means the price moved downwards. So why is this useful? Well, it can give you an idea of how strong a movement is. You can see right here, a lot of people were selling. There's a lot of sell volume. And then over here, there's not a lot of buy volume, even though there's a breakout. So what's going on here? And we can also see that volume has kind of been decreasing over time, which means traders are not trading as much as they used to. And this can kind of be a general idea of when you can expect a breakout. I typically look for volume to bottom out, and typically when volume bottoms out, like around here, you can see how volume has steadily declined. I can use a trend tool to kind of show you guys how it's gone down here. You can see that volume has bottomed out, and you can see it got to its lowest point here, and then you can see how it's made a recovery. There's a breakout here, and the price went back up. So that's just kind of one way you can use volume. Or perhaps you see a breakout and you're like, there's not a lot of buy volume, even though it's broken past this resistance. And one thing I forgot to mention with support and resistance is once you break past a resistance level, that resistance level becomes support. And if you break through a support level, then that support level will now become resistance. That's just kind of how it works. That's just how psychology of the human mind works, I guess. So that's just things you want to keep in mind while you're trading. So that's pretty much volume. You'll find ways to make it work for you. Let's look at some other tools that I really like to look at. So let's take a look at ATR. If you're a day trader, you're probably using ATR, average true range. I don't use this too often because I'm not doing a lot of day trades. I'm not looking for stop losses. I'm here just to accumulate more crypto. But if you're day trading, ATR can be your friend because it's going to show you the average move of that asset during a time frame. So if you want to calculate your risk, a good way to do it is by dividing your ATR by the price that you entered in at, and it's going to give you a percent ratio. So if you do, and I can type this up for you guys. So if you want to calculate risk equals ATR divided by the price you entered at. And that's going to show you the maximum amount that you could probably lose during that trade. And then you'd probably set your stop loss at that ATR. So if you want to set your stop loss so that, and we went over that when we were going over the exchange, you can set your stop loss or the stop limit order. You can put your stop at the price that you entered at minus ATR, because if it goes below that ATR, just, you want to cut it short. It's not supposed to move that much. Just it's probably going to continue dipping. Just exit the trade because you didn't expect it to go that low. But you also want to give yourself room for it to dip a little bit, so you don't exit the trade too early because it might recover back upwards. So that's why you would use the ATR. And then if you wanted to calculate your profits, you could do your profits will equal the price that you sold at divided by the price that you entered at. This is going to give you a nice ratio. So you're going to get a percent from this, a percent from your risk, and then if you do profit divided by risk, you're going to get yourself a ratio. Now what that ratio is up to you. I personally prefer a 4-to-1 ratio. For every dollar I'm risking, I like to make $4 in return. So if I'm not confident I can make $4 off that $1, I wouldn't even enter the trade. Some people look for 2-to-1. Some people look for 3-to-1. I prefer 4-to-1. That's just me, but you can adjust these numbers to fit your personal risk tolerance, and that's just kind of recommend how I do it, how you should do it. But like I said, everyone does technical analysis differently. You do it how you want to do it. So we'll just leave this here for you guys to look at if you want. So that being said, I don't use ATR too much. I like long-term trading. So let's go back to our indicators here and take a look at some other useful features. So I'm going to open both up at once because I really like these. So I'm going to open up the MACD, and I'm also going to open up RSI. Now, these are going to give me two things that look really complicated. It's not complicated. So we have our MACD here, which are moving average, convergence, divergence, and you're going to see two lines on this, and it's not, and then some like some green and some red here, some movements, you could say. What this is really showing you is the MACD line and the signal line. So our MACD line is here in blue, and our signal line is here in orange. So what the MACD line is the 26-day moving average minus the 9-day moving average, and it's going to give us this line here. And then we have our signal line, which is the 9-day moving average. And this is going to give you your buy and sell indicators. So if the MACD line is above the signal line, that typically means there's an upwards movement that you should buy, and it's reflected by these hills here. You could say these movements here, and you can see where the peak of the movements kind of have been. So yeah, now if the MACD line crosses below the signal line, that's a sell indicator. That means the price is probably moving downwards. So let's look at some good examples of this. We can go right up here, and we can see that the MACD line right here crossed above the signal line, which is a buy indicator. So traders are probably buying in somewhere around here, and you can see how this worked out for them. The price went upwards. Now it kind of looks like it's peaking out, so people started selling around here because now it's about to give a sell indicator where the MACD line is about to fall below the signal line. So people started selling here, and you can see that the price went down. And yeah, that's pretty much how these indicators work. It's quite simple. Now, the MACD line isn't enough to justify making a trade. You want to look at what are the patterns saying, how do these patterns typically play out, and most importantly, I like to look at the RSI. The MACD RSI strategy is pretty much all I ever use in my trading, combined with patterns and such. because it's such a strong combo and it's really all you'll ever need to use. So what the RSI here is the relative strength index. What this is showing you is the asset overbought or is it oversold? And it's going to do this by putting you on a scale from 0 to 100 with anything from 70 to 100 being overbought and anything from 30 and below being oversold. Now, if something's overbought, that means it's things typically like to find some kind of equilibrium, right? So if things are overbought, traders are going to start selling it, and that's going to force the price downwards. So we can see that it was overbought here. People started selling, and that's why we had this dip here. Now it's coming back into this overbought territory. Doesn't necessarily mean the price is going to go down. It just means that it's overbought and that you might be paying more than what it's really worth right now. And you can see in the past how things can typically stay up there for quite some time. So that's just one way you can use it in combination with the MACD. So yeah, it's overbought, but the MACD hasn't given a sell signal yet. So that's just something you can look at. Alternatively, I like to just wait till the RSI bottoms out. Now the asset's oversold. People are going to start buying it. That's going to force the price upwards. So the people who are buying when this asset was oversold here, I mean, yeah, they made some money here, but it went down a little bit. But people who continued to like dollar cost average themselves in when the RSI bottomed out, long term they're doing pretty decently. It's it's had to move back upwards. But yeah, the price typically moves back up when it's oversold, and you can see that it's oversold here, and there was even a buy signal here. And so people probably bought in because both of these are telling them to buy. It's oversold. And it's also given a buy signal to MACD. So people buy in and they wait and see, and you can see that there's been a movement upwards. So that's how I like to use the MACD and RSI. And how these indicators work, it's really just based on math, and you just have to trust the math. And you'll just see if these indicators work for you. You don't have to use the indicators, but I personally prefer them, and I want to show them to you guys. So I always leave these two open when I'm trading. That's just, these are the two that I really use a lot. So I just keep them open the entire time. The last thing I want to show you guys, and maybe I should have mentioned this first, is our exponential moving average. Now, these are going to give you a multitude of lines, and you've probably noticed them since the start of the video. We have our 20-day moving average, or exponential moving average, our 50-day exponential moving average, our 100-day exponential moving average, and our 200-day exponential average. What these basically do is give you indicators. You can think of these as your support and resistance levels that kind of move with the price, because they're basically the average of the price during a given time frame. So this exponential moving average here, it's basically the average price of the asset during the last 20 days of that period or whatever. So the greater the time frame, the greater the lag is going to be, as you can see, because 200 days is a long time. It's taking into consideration some prices down here and up here, and it's averaging it to get around down here, right? So the longer the time frame, the stronger support it is considered to be. So and the shorter the time frame, the weaker supports continue to be. So you can kind of see how the price has risen with the 50-day exponential moving average, but sometimes it dips below a little bit, right? And then you can see that this 50-day exponential moving average is quite a bit stronger. It's typically recovered from this 50-day exponential moving average, or 50-day EMA. We'll just say EMA to make things easier. And then when the crypto market kind of gets hit, it can tank down even lower. And you can see that traders are actually buying in at this 100-day EMA now, right? Because that's pretty strong support. So people bought in, the price recovered, but it continued to dip even more, and it broke through the 200-day EMA, which is not a good sign. That's typically a bearish indicator, right? Now this 200-day EMA is going to serve as resistance, because remember, if you break through support or resistance, it's going to flip-flop. It's going to change signs. So we broke through the 200-day EMA. Now it is resistance, temporarily at least, because it just rebroke through. You can see that we had a movement, broke through the 200-day EMA, and then landed back on it and rebounded. That's kind of how support and resistance works. So yeah, cool indicator. I always use EMA. Now the alternative is the moving average, which is basically the same thing as the EMA, except it doesn't place higher weight on recent data. So with the EMA, it's going to place higher weight on, that's why it's called exponential moving average, because it's going to put higher weight on the more recent data, so it kind of gives you more accurate readings, you could say, whereas the MA, it doesn't do that. The moving average doesn't do that. And you can pretty much go up here and look up what you want. You can do MA has your moving average, or you can do EMA, which I like. I use this one right here. It's something great. That's what I like to use. But it's really personal preference, whichever one you want to use. But in terms of technical analysis, that's pretty much all the indicators and tools that I ever use. Okay, so the last indicator that I forgot to show you, so this is me in the future coming back to show you a cool uh, indicator that I also like to use. It's called the Bollinger Bands. And ignore all this stuff I drew. I don't remember if I drew this earlier or not. But anyways, it's gonna show all these bands. These are called the Bollinger Bands. And what this is gonna do is show you kind of the volatility of the asset right now. And these are great because typically the price bounces in between the bands, right? So you're always gonna want to buy towards the bottom of the bands here. If you're looking to like buy the dip and dollar cost average yourself into positions. But yeah, so how can you use the Bollinger Bands to help you out? Well, you're going to want to buy towards the bottom, right? But they can also kind of give an idea of where the movement's headed. You can see that over here, we've kind of just been like glued to the bottom Bollinger Band, right? It's kind of dipped outside a little bit. That's typically a strong indicator that this is a strong movement. So if the price is kind of just glued to the outside of the Bollinger Band, you can expect the price to keep going that way for some time. And that's kind of what happened here. You can kind of see a dip, stuck to it, and it just went down, right? And then we can also see that here, it went up here, it kind of glued to the top, and it just kind of went up. And now it's kind of retraced down a little bit and just kind of hit the top again or whatnot. And it might eventually come back down to meet this bottom Bollinger Band somewhere. But yeah, another thing to note with this is there's going to be constricting of movements, and there's also going to be widening. Typically, when you have a constricted movement, that means there's not much volatility and there's likely to be a breakthrough. So we can kind of see how it's widened here and then it's constricted, and then we have the breakthrough where it widens again. So that's just kind of one way you can use it to kind of see when there's going to be some kind of price movement. And then also when you see super wide price movements and whatnot, or super wide bands, that can also be an indicator that there could be an end to the current trend. So what do I mean by that? Well, you can see the price moved up here, and now we've kind of seen the widening of the band right here. And that means that, yeah, maybe it's not really going to go up anymore. And it did not go up. It reversed downwards. So that's just something you can look for. You can see there's a widening of the band here. Price did go downwards, constricted a little bit, and just glued to the top and moved to the top. So that's kind of how you can use the Bollinger Bands to help you. I like this. Use it in combination with MACD, RSI, all the other indicators, all your patterns, and that should give you a better idea of what you're doing while trading. Alrighty, so now let's go ahead and take a look at some trading patterns you should familiarize yourself with, because these are going to appear pretty often and they can give you a general idea of where the price is going to be going. So these trading patterns are made from the emotions of other traders. They're going to be buying and selling at prices they deem fit, and that's typically going to create some pretty predictable patterns, and you can take advantage of this if you can recognize them and make the trade properly. So that being said, these patterns are going to reflect the emotions of other traders and also give you a general direction of where the price could be headed. You're going to notice here that there's going to be periods of consolidation in each of these patterns where the price is just kind of trading sideways or up or down slightly, but it's not making any strong moves. And that's where traders just have some disagreement. They're unsure of where the price could be headed, so you have different parties buying and selling, which is kind of creating these up and down movements which aren't really going in any direction. There might be a slight downtrend or a slight uptrend, or maybe even trading sideways, but it hasn't really made up its mind and picked a direction to go yet. And once these traders agree on what the asset is worth, whether it's worth more or less, then the price will move sharply in that direction. And lastly, you need to understand that none of these patterns are for certain. Just because you see a pattern doesn't necessarily mean that the price will go that way. So make sure to use all of your other indicators and see what's going on with the news, and ensure it's a project you believe in, because sometimes the price may not go the way you expect, but it's just another piece of evidence you can add to your collection of evidence to where the price you think could be headed. Alrighty, so let's go ahead and jump straight into it. So there's three different patterns that you're going to want to recognize. There's what I call bullish patterns, in which the price will typically go up. You're going to have some bearish patterns in which the price will go down, and reversal patterns, which kind of show you when you're at the peak or the bottom of the movement. So for our bullish patterns, the first one to note here is what is called the bullish flag. Now, why is it called the bullish flag? Well, because you have a pole and the flag section, and it kind of looks like a flag when you draw it out on the charts. So what's going on here is you're going to have a sharp increase in the price, a period of downtrend consolidation, and then after this period of consolidation, the price will shoot back up again. So that's kind of what your bullish flag looks like. And what's probably going on here is the price is going up, people are buying it a lot, and then it hits kind of a roadblock, that resistance line, and people are kind of unsure of where the price is headed. So they start selling, the price kind of trades sideways and downwards a bit as bulls lose support, but the bears don't have enough momentum to really push the price back down. So people start buying in as if it's the dip, and it's going to force the price back upwards. That's kind of like my own little theory on what's going on here. The next pattern we have here is what we call the bullish pendant, and it is very similar to the bullish flag, except the only difference is these converging support and resistance lines. You can notice with the bullish flag that they're going to be kind of parallel to each other, but not necessarily. But with the bullish pendant, they're converging. And what this kind of tells you is that traders are kind of narrowing it down to what the asset is really worth. And about 2/3 through this like triangle movement here, there's typically going to be some kind of breakout. And with the bullish pendant, in this case, upwards. So you're going to have this original upwards movement, this downtrend consolidation with converging support and resistance, and then another movement in the upwards. So with the bullish flag and the bullish pendant, how much higher can you expect the price to go? Well, typically the movement upwards is going to be equal to the pole. So you can just measure the pole, how much the price increased, and then just kind of draw it on top of the resistance line where it broke out, and that's going to give you your next price target. And you also might be wondering, well, how long are these time frames? How long are these time frames do you got to look for? It can really be anywhere from a few hours to a few days. So you just got to kind of scroll out until you see one. But typically about 2/3 through the triangular consolidation. It's a little harder to tell with the bullish flag. You're going to notice some kind of breakout. And you might also notice that bullish pendants are typically going to break out much faster than a bullish flag might. So the next pattern we have here is called the cup and handle. Why? Because it kind of looks like a cup and handle. So what's happening here is you're going to have a price increase. It's going to hit this resistance line, and there's going to be this U-shaped consolidation. It's literally going to look like a U with the price. And it's going to hit this resistance line again. Now, instead of immediately going up from this resistance, you're going to see this slight downtrend consolidation before it hits some kind of support and takes back off again. So when you see this pattern here, you know it's going to be bullish. You have this U-shaped consolidation, which is called the cup, and then this downtrend consolidation is called the handle. Once you see the candle, you kind of have an understanding that you're in a cup and handle pattern, and you kind of know that the price is typically going to pick back up from here and break past that resistance. Alrighty, so now let's go ahead and talk about some of these triangles you should be familiar with. I put them with the bullish patterns because they can really be bullish or bearish, but it just depends on the circumstance. So with the symmetrical triangle, what you're going to notice is literally a symmetrical triangle. So whether or not the triangle is actually symmetrical or not isn't really much of a concern. What matters here is that the asset is trading sideways. So the price could have dropped into this or have rose into it, and what you're going to notice are converging support and converging resistance lines. And the price is going to trade sideways in this. And about 2/3 through the triangle, there's typically going to be a breakout. Now, whether or not it goes up or down really depends on how it entered the symmetrical triangle. If you're in a bullish trend, typically the symmetrical triangle will continue the bullish trend. And if you're in a bearish trend, typically the symmetrical triangle will continue the bearish trend. But use your indicators, use your other pieces of evidence, and draw your own reasonable conclusion on where you think the price could be headed once you enter a symmetrical triangle. Next up is the descending triangle, probably one of my favorite patterns. And to be honest with you, I've noticed this to be a very strong bullish indicator. But a lot of other people may tell you that it's bearish. So like I said, come to your own reasonable conclusion after drawing in all your different types of evidence. But I've seen this bullish, so let me go ahead and explain why. So we have the price decreasing into this typically, and then it's going to hit some kind of common support. And this support line is going to be horizontal, and the price is going to be bouncing off the support line typically 2 to 3 times. Now what this tells me is that this support line is going to be very strong, and I like to buy at very strong support levels because you're going to know that the price is going to rise from it eventually. And it's also worth noting that you're going to have this descending resistance, and that's why it's called a descending triangle, because it's just a descending triangle if you look at it. So what's happening here is traders are kind of narrowing down the price down to the support level. People decide that, yeah, this is kind of strong support. We're in a long-term bullish trend perhaps. I'm quite bullish on this project. Whatever it is, people start buying at the support level, forces the price out of the pattern. They're going to have a breakout of this resistance, and the price goes up. However, if it does not break out of the pattern, then yeah, it'll probably be bearish, and you can expect it to drop some more. Next up is the ascending triangle, which is quite the opposite from the descending triangle. The price typically rises into one of these, and you're going to have your horizontal resistance line with a converging support line or an ascending support line, which is narrowing down the price towards this resistance line. Now, because the price will hit off this resistance line many times, it typically tells me that it's quite strong resistance and people want to sell there or take profits. Now, people will tell you that this is a bullish movement, and it's typically regarded as a bullish movement, but I've also seen it be bearish. So, just use your other indicators, see for yourself where it's going to go. But with this pattern, it can really go any way. But yeah, if you use your other indicators and you just kind of see what's going on with the market, you'll typically be able to play it out quite well. But the key thing to note is just look for breakthroughs. If it breaks through the resistance, then yeah, it's going to be bullish. But if it breaks through the support, then it's going to be bearish. So use your own judgment and you should be all right. Alright, so that covers all of our bullish patterns here. The next thing to get into are the bearish patterns. Now, it's good to know bearish patterns because you kind of want to have an idea of when the price may go down and maybe you should take some profits. So, just like we had a bullish flag, there is a bearish flag. And with the bearish flag, what's happening here is we're having the price decrease, creating this pull, and then we're having some ascending consolidation right here, and we're going to have our parallel resistance and support lines before the price dumps again. So the bearish flag can be quite detrimental to a lot of new traders who aren't entirely sure of what's going on, especially with these patterns, because they're going to see this decrease in the price, and now the price is going back up again, and they think that this may be the dip, always buy the dip, right? So they'll buy into this bearish flag, but then what happens is that the price dumps on them. So be careful with the bearish flag. If you see that the price is going up, but it's not a strong movement up or it's not a reversal, then it's possibly a bearish flag if it looks like this, and you will get dumped on. Next up, just as we had the bullish pendant, there's also the bearish pendant, in which we're going to have this decrease in the price, creating the pull, and our converging resistance and support lines, creating this bearish pendant before you get dumped on. So same thing applies with the bearish flag. You're going to see the price go up again, but it's a trap. You will get caught in it, and you're about to get dumped on. So be careful with this one. Alright, so next up is the inverse cup and handle. So what's happening here is you're going to have a decrease in the price. It's going to bounce off the support line and create this umbrella shaped consolidation, or this inverse U or inverse cup as it is derived from the name. And then you're going to have your handle in which it bounces off the support again before it dumps back down. You can see we have our inverse cup right here, and the handle is this upwards consolidation. That's really all about it for the inverse cup and handle. Don't fall for this parabolic shape here. It's a trap. Alright, so lastly we have our reversal patterns, which are very important to know. I mean, all of these patterns are quite important to know, but reversal patterns will tell you when you can expect the price to go back up again or when you can expect it to go down again. So the first one I like to look at is the double bottom. Now this one is incredibly easy to spot. You're going to see the price decrease, hit a common support, go back up a little bit, and then hit that support line again before taking back off in the opposite direction. Now what's going on here? Well, you hit some common support, hit it twice, could hit it 3 times, maybe even more times than that. But generally, the more times the price hits that support level and bounces off of it, the stronger support that's going to be from then on into the future, which means that it's likely that the price will return off of that support and head back towards that resistance line where it could potentially break through. You know, when you see the W, that means you're about to take a win. So the double bottom is kind of great to know when you're kind of at the bottom, so keep an eye for it. Next up, we have the double peak, which is the opposite of the double bottom in short. So what's happening here is you're having the price rise. It hits this common resistance in which the price will kind of retrace off of for a bit before heading back towards that resistance to test it again. It fails and the price heads back down towards that support level, and if it breaks through it, it can continue to dump more. This M you see here does not stand for the millions you're going to make off this trade, but the millions you could lose off this trade. So if you see the double peak, understand you're looking at some pretty strong resistance and that you should consider taking profits. Alright, the last two here, we have the inverse head and shoulders and the head and shoulders. So with the inverse head and shoulders, we're looking at a bullish reversal trend. So what's happening here is the price is decreasing and it's going to hit something called the neckline, which kind of serves as some temporary support. And what's going on is the price decreases, hits the neckline before retracing upwards a bit, and then dumping straight past it to form this head. So our first shoulder has formed. Now we have our head in which the price has decreased past it before it comes back up again and forms the second shoulder and then landing straight back on the neckline. So once you kind of get to this section right here where you see the first shoulder, you see the head which protrudes past the shoulders, and then you see the second shoulder, you're going to know that you're in an inverse head and shoulders pattern in which you know the price will return to the bullish trend. This is kind of what it looks like. It's kind of difficult to put into words, but you're going to see it kind of look something similar to this. You're going to see about two shoulders about equal size, and you're going to see the head clearly poke through both shoulders. And your neckline, it could be horizontal, maybe slightly slanted, but it's typically going to be somewhat straight. And your shoulders don't necessarily have to be incredibly equal, but they're going to be roughly the same size. So if you see something that kind of looks similar to this, you're probably in an inverse head and shoulders. And then lastly, we just have the regular head and shoulders, or just the head and shoulders. And with this pattern, what you're going to see is an increase in the price, which shoots past the neckline before retracing downwards to bounce off the neckline and form that head. Once at the head, it's going to head straight back towards the neckline, bounce back off, and form that second shoulder before dumping past the neckline and entering a bearish trend. So it's going to look kind of like this. And the same thing I said for the inverse head and shoulders kind of applies to the head and shoulders. You know, you might see a slanted neckline perhaps. The shoulders might not be entirely equal, but you're going to notice that there's two shoulders and a head protruding through them. So that's going to wrap it up for all of the patterns here. These should help transform you into a much stronger trader because these patterns are just going to give some general guidance of where the price can be headed. Now, typically long-term hodling is always the best option because it's kind of hard to lose when you're holding incredibly long-term because we're still quite early into crypto. But regardless of that, these patterns could help you buy in at a better price. And if you're looking to trade, these patterns can help you trade as well. So that's going to do it for this video, and I will see you in the next one.